Yeah, well, I think, I mean, as usual, the markets get ahead of this, and what the markets are anticipating now, the bond market and the equity market, that the Fed will be cutting sometime in the next, 2 to 6 months. And even our house call, I mean, our house call is for no cuts this year, but then they have 7 cuts next year. I mean, that's like wildly bullish for equities. Okay, so you almost have the perfect setup, Tom, because what you have now is lagging economic data, which is what the Fed uses to make decisions, and you already have the equity market and earnings revisions telling you what's going to happen. So they're looking backwards, and they're going to be looking at lagging labor data, and then of course lagging inflation data, which should come down ultimately later this year, next year, and they're going to cut into that. And but there's not going to be a knock-on negative effect for earnings revisions in the way that people kind of assume when
Mm.
you get that sort of decline in labor data. In fact, I would argue, because it's gradual, that we're going to see revisions go up, because when companies reduce headcount, it actually accrues to margins.
Mike, what is screening well for you now? I'm not sure if it's sectors that you guys screen by or different factors that you screen by. How are you looking at this market, and maybe where opportunities might be?
Right. So we do both. We look at factor revisions, we look at sector industry revisions, and we look at the stock level too. It works in all those areas. And so we've been rightly positioned really since April to be overweight financials, industrials. Those are the two favorites, and also software to some degree. And those have been the areas where the revisions have been the strongest. And I think that probably could continue. And so at the end of the day, I do think the biggest opportunity going forward is the areas that have not seen those revisions yet. So let's talk about the industries where we've been sort of in this rolling recession: housing related, okay, commodity
Mm.
related, some of the consumer goods areas, which are going to feel the effects of tariffs now. So in the very short term, we actually think revision breadth could come down a bit as some of these tariffs flow through the cost of goods sold. But that's just going to create the next buying opportunity, perhaps in these areas that have lagged, even small caps, because they will love the fact that Fed's cutting rates at some point.
Mike, one of the themes today, and really for the last period of time, has been concentration risk in this marketplace. It seems like only a handful of stocks are driving the performance. But I think what we're kind of coming to the conclusion of, or at least rationalizing, is because that's where the earnings growth is. That's where the free cash flow is. How do you think about that issue?
You're exactly right. I mean, the market's not stupid. I mean, like first of all, what drove the market lower in the first quarter? The Mag 7. You know why? Because the Mag 7 earnings revisions were terrible in the first quarter. We had an AI capex deceleration. We had questions around whether it's going to generate ROI. Revenue growth kind of decelerated a bit. So it happened for a reason, but it has nothing to do with tariffs. Okay, it has everything to do with just the natural evolution of this AI cycle that's going on. So I think, coming out of the April lows, the reason why the Mag 7 led is, well, A, they're big and liquid, everybody loves them, but also because they were seeing a rate of change bottom in the revision factors. And I'll give you two huge catalysts for that: the weaker dollar, okay, which accrues to the large multinationals, particularly some of the Mag 7. And the second one was that we saw that, NVIDIA could no longer they could no longer sell chips to China, and they took a big write down on inventory. But now they can sell those chips when the inventory is at zero.
Right.
Okay, so what does that tell you? Gross margins are going to be basically manufactured for the next year. So there's a lot of reasons, why stocks do what they do. But the
Right.
main reason, our whole franchise, as you know, focuses on earnings, not lagging economic data.